investor expectations. And I think this is always important because as an individual investment advisor, I think probably my most important job or most important thing of my job description would be managing expectations. The worst thing is when you have an expectation that you're going to earn a certain amount of money and then you earn a lot less. It's much better to I guess, think you're going to make a certain amount and over or outperform. That is obviously a much better thing to do, but tough to outperform the market currently. As I mentioned off the top of the show, we came into the second quarter of this year. S&P was up 10.5%. We had the TSX up 6.5%. That NASDAQ, which blew the lights out last year, up just under 10%. So the expectation, well, how long can this last, Alan? Can this market continue to move higher? Well, I think it can move higher, just not at the current pace. And we've seen a sell-off in the markets over the past, let's call it 2.5 weeks in April. We have an S&P chart here, our second chart in this segment. We can show it. It will show the S&P 500 tailing off. And there you see the tail off because the expectation should be, well, we came in hot. At some point, the S&P 500 is not going to be up 40% for the year. So we're going to do well this year, but things are just going to have to slow down. So there are going to be points in time where the market gives back something. And it's funny because we never know what the reason is for that give back. Is it, geopolitical? Is it higher interest rates? Is it Fed speak? What is going on? Is it corporate earnings? What is going to take this market down or at least flatten it out for a period of time where we don't see the big gains that we once had? And obviously, market being down in April is because of interest rates, because the Fed has said, well, maybe we're not going to see 3 rate cuts. We're not going to see 5 rate cuts. We're not going to see 3. Maybe we'll only see 1 or 2. Maybe they're going to happen maybe just in the last quarter of this year. So I think that has helped take down this market. So investor expectations need to be correct. What am I saying? Well, I'm not saying sell your investments because we're pretty much not going up from here. I still believe the market will be higher at the end of the year than it is now. But if you made 10% in the first quarter, maybe you only make 5 to 10% more in the next 3 quarters before the end of the year is done. So maybe that's what's going to happen. Maybe you make another 5, 6% over the next 9 months versus 10% in the first quarter. I'm not so sure how that looks, but I think the expectation should be that it's going to slow down, and you have to be mindful of that. As I said, don't try and time this market. Even though the overall market may be slowing down, there are still many individual investments within the index that may have blowout quarters in the next 3 quarters, may be doing tremendously well, and their stock price today is undervalued, and that one day or at some point in time, the valuations will be realized that the stock should be much higher. So don't get caught up on the overall index. I would look more at individual names, bottom-up stock picking, bottom-up investment picking, as more of a way to really share in the gains that we're going to see over the next 3 quarters and not necessarily rely on that ETF or index, the S&P index per se. An interesting chart we have here that I'll leave you with, investment returns expectations in 2023. And this is really interesting because what you're going to see is what investors expect versus what investment advisors or financial professionals are expecting. And it's tough to see the writing on here, but I can tell you the orange are the investment professionals and the blue are the investors. So for example, in the United States, investors were expecting a 15.5% return. Financial professionals were only expecting a 7% rate of return. And when you look at China, Mexico, Singapore, investors are expecting similar results to what the investment professionals were thinking. Japan also, pretty big gap between the blue and the orange dot. You look at Canada, 10.5% investors are expecting or were expecting in 2023, 6.5% were the professionals. So interesting. And if you scroll down, or you can see here at the bottom, you can see that in the US, over 2 times greater were the expectations of investors. The others, Canada, 1.6, Australia, 1.8, Japan, 1.6. So clearly, in a number of these countries, the investors are believing that their expectations, or the market should be able to give them higher returns than the pros are were expecting. So overall, understand where we are in the market, understand the environment, understand that you can still make good returns, but overall, the index will probably slow down in the coming quarters, maybe ramp back up towards the end of the year from a historical standpoint in terms of seasonality. But overall, expect the markets to slow down, but that does not mean that your portfolio has to. And we will continue to try and find good quality investments to build as part or to own as part of a nice diversified portfolio.